All right, 6 o'clock. Make sure if you're on Zoom that I can tell your name. I can tell everybody there. Juan Carlos, Mark, Dan, Nicole, Elijah. Yeah, I can recognize their names. All right. If y'all see someone come on and their name is Kitty Cat something or whatever, no, maybe chat that they need to put their name in there. All right, so what we're going to do now, we're practicing for the exam. We only have 2 more classes. I'll probably not put this entire class on YouTube, but I'll work some of the problems. So what we want to do is make sure y'all ace this exam. So I'll give you a bunch of the problems. So let's start with this first one, which is not one that you would actually work. This is out on Canvas. So if you want to load this file, it's out on our Canvas. The very, very bottom under exam reviews. I added this last one right here. So this is the problem set I'm working. So you might want to pull that out and load it. If someone's not ready, unmute and let me know you need a little more time. Are you able to find it, Akash? Okay. So there's like 40 people in the room here with me right now. You count each of us as 20 people. All right, are y'all ready? Anybody not ready? All right, so in this first problem, you might get a level term, a whole life. So the thing to remember, if it says 4-year, then 4-year, you're going to have 4 D's in the numerator and 4 L's in the numerator and denominator. All right, it says 4 years, so 4 D's in the numerator, 4 L's in the denominator. The only reason that wouldn't be the case if I say it's limit pay. If it's limit pay, you're still always going to have 4 D's in the numerator. How many L's you have depends on if I say they pay premiums for 2 years or 3 years. All right, so the numerator is always, for life insurance, is always D times the face divided by 1 plus I to the n. So here you have a 4-year level term. The value is 10,000. The interest rate is 4%. So you're going to have 4 D's in the numerator, 4 L's in the denominator. If it's whole life, ordinary whole life, you go until you hit age 99. So if I give you a whole life starting at age 95, then you would do D95, D96, D97, D98, D99. So whole life, your D's go until the end of the table. Same thing with your L's. Your L's go to the end of the table. All right, so these problems are pretty straightforward. You notice I'm not asking you to calculate anything here. I just want you to write the formula. So when you write the formula, I want to see D's. I don't want you to actually get the numbers. So it says use symbols rather than pull numbers from the mortality table. All right, so don't go to the mortality table on this. Just use D's. So you'll use D30 instead of finding D30 in the table. I do want you to write out the 10,000 and the 4%. All right. So I'll give you a couple minutes to write this one out. Then you can see if you did it in the format I'm looking for. All right. Let's try this first one. So you're going to have D30 times 10,000 divided by 1 plus 0.04. Or if you want to, you can actually even just write 1.04 if that's faster. Then D31 times 10,000 divided by 1.04 to the second. Is all that making sense? Plus D32 times 10,000 divided by 1.04 to the third. Plus D33 times 10,000 divided by 1.04 fourth. That should be your denominator. Any questions on that? See how I've written out, you don't have to use dollar signs on the 10,000. You don't have to do the 1 plus 0.04, 1 plus 0.04. You can just type 1.04. Right, I'm going to move on. Y'all need to unmute. Chat doesn't really work well. So if you have a question, just hit the unmute and just interrupt me. The denominator, it's the same, except for it's going to be L's. So L30 plus L31 divided by 1.04 plus L32 divided by 1.04 to the second plus L33 divided by 1.04 to the third. Remember, when you're doing L's, the raised to the power will always be one less than the D's. D's always happen at the end of the year. L's always happen at the beginning of the year. So you'll always be off by one. So that's what you should write on the exam. And I'm going to put this Excel file out there on the exam review. So you have not just these exam reviews, all the other problems we worked. Any questions on that one? All right. Boy, got her so quiet. You don't want to speak for everybody else and unmute and say you're good, sis, but that's fine. All right. So no number crunching, nothing to pull from the table. Just write that down. You'll probably have 2 or 3 of these where you just fill that in. So pretty straightforward problem. All right. The next question is a do solve. This is probably the longest problem there. So we just did a life insurance product. This is an endowment. Remember, for the endowment, it looks exactly like the level term with one exception. After you do all the D's, you're going to add an L at the end because remember, it pays death benefits. And at the very end, it pays the people alive. So here you have a 3-year. When you see that 3-year, you're going to have 3 D's and 1 L. So anytime you have an endowment, 3 D's and 1 L. And then the denominator is going to be exactly the same as the previous one. You're going to have 3 L's. All right. So write out the formula just like we did the previous problem. And then we'll put the numbers in because here you do have to calculate. But write out just the premium itself in the formula format. All right, let's try it. So this is issue age 50, so D50 times 855. D50 times 855 divided by 1.04 plus D51 times 855 divided by 1.04 squared plus D52 times 855 divided by 1.04 third. So it's 3 years. If you see 3 years, you have to have 3 Ds, and then you're going to add an L53 times 855. And here's the tricky part. You divide it by 1.04 to the third, not to the fourth, because remember the L's are paid at the beginning of the year. So essentially you're going to pay D52 in 3 years. At the end of the third year, you're going to pay L53 at the beginning of the fourth year, which is really to the third power, all right? That's the one tricky part to make sure you have. Then your denominator is really simple. It's just L50, same thing as we did before, plus L51 divided by 1.04 plus L52 divided by 1.04 to the second. So very, very straightforward. Any questions on that? So now it's just a matter of getting the numbers in. I'm going to go get them out of the table, but you will have to do that yourself. You do have the table at the bottom of the Word document. So we need D50, 51, 52. You need L50, 51, 52, and 53. So you need 4 L's and you need 3 D's. So you just have to get those off the table. Nakash, I don't know if you have the table in front of you. You can write them down, or if you want to write them down real quick. You can see it. All right. All right. So hopefully you all have access to that table. So I'm going to bring it in Excel so I can see it a little better. You can't do this on the exam, but you got D50, 51, and 52. And you got L50, 51, 52, 53. So I'm going to bring those in. D50 is 622, then 673, and then 729, and L50 92. This is where you have a big numbers. Unfortunately, there's big numbers here. L50, L51, L52, L53. I'm going to calculate it now. This is something to practice on your own because we're limited on time. You might practice, make sure you're getting those raised to the power all working on your calculator. You might use the parentheses. You could on the exam, write each piece out if you wanted to, but I'm going to do it like this. I've got D62 times 855 divided by 1.04 plus D51 times 855 divided by 1.04 the second plus D52 times 855 divided by 1.04 to the third plus L53 times 855 divided by 1.04 again to the third. Divide all of that by the sum of. Make sure you get the sum of. You get your parentheses in the right place. So you got to add L50 plus L51 divided by 1.04 plus L52 divided by 1.04 the second. I don't know if anyone has an answer yet. It's going to be a small number because the payout's only $855. But one thing to think before you hit enter, they're going to pay 3 premiums and everybody's going to get $855. So your premium, if everyone's getting $855 and not that many people die. So most people, this is the time value. So you're not going to be radically off of 855 divided by 3. So can you see on a modified endowment, you're not going to be radically off. So 855 divided by 3 is 285. You can see our answer is 265. So not that many people die, and as such, your premium payer is about the same every year. They're going to pay the same premium for 3 years, and everybody's going to get 855. So your premium is not going to be that radically off. So keep that in mind. You can take the payout divided by 3, and your answer is going to be lower than that, but not radically lower than that. This is not level term. Remember, with level term, you don't have that final L to pay out. Level term, the premium will only be $6. But here, everybody's getting the $855. The people who die get $855. The people who live get $855. So your premiums get pretty close. Does that help some in getting a ballpark what it should be? So, think about that as you do a question like this. That way you're not radically off. I don't know if anybody can confirm that they got that number. I wish I could do the exam on Excel. That would be really great. Now, we're not going to do this next part in total. I'll set it up and do it. But the real key here is you've got time 0, time 1, time 2, and time 3. You're going to have the same number of times as you have D's in the numerator. So what happens at time 0? You collect your premium and you invest 4%. Okay. At time 1, you pay you pay claims, you collect the premium, and you invest. And then time 2 is the exact same thing. Time 1 and time 2 are exactly the same thing. So we've collected 3 premiums, 1, 2, 3. So time 3 is going to be the same as time 2, but you're not going to collect any premiums. So you can say pay claims. You can say pay claims twice because remember, you're not going to invest again. So you pay claims to the dyers, you pay claims to people still alive. So it's going to look something exactly like this. So you collect your premiums, you're going to take L50 times the premium. So I'm going to set it up, but this is what you want to do is really tough calculations. So L50 is 92,793 and our premium is 265.36. So we're going to collect that premium. go out 2 decimal places. You don't need to go out any further than that. And then we invest at 4%. One thing I left out that you're probably sorry, you're probably going to add a row here. At time 1, you want to bring the portfolio forward. So you invest at 24 million. You want to multiply that by 1.04 because you're making 4%. So your portfolio comes forward at 25 million. You're going to pay claims to the D50s times 855. So you take D50 times 855. You're going to pay that out. I'm going to change all this to dollar signs. You can collect your premium. So L51 times the premium. Kind of just see the pattern here. It gets pretty redundant. So L51 times the premium. You collect that and you reinvest. You come to time 2, you bring the portfolio forward. Again, it's at 4%. So you take that. Well, one thing I forgot to do here, you need to show the net. So the net is you started with this amount, you paid out that much, and you added that much. So it's beginning minus claims plus the premium. That's going to be your ending balance. This ending balance is going to get really, really large because you're going to pay out a whole lot at the end because you're going to pay it out all to the L53s. So don't worry that you're getting a massive number because that makes sense. That's the portfolio you're going to bring forward. So that times 1.04. Again, you're going to pay the D51s, $855. So D51 times 855. You're going to collect premiums from the L52s. This is the last premium you'll collect. L52 times my premium. And then you do the net, which is going to be beginning minus claims plus the premium. So the beginning was 51 million. We paid 57,000. We collected that. So we have a really large balance. And then we have time 3. Bring your portfolio forward. Here we better get a really, really round number in Excel. On the exam, you won't because you have some rounding issues. But here we should get a really round number. And we did. Pay claims. First, we're going to pay our death claims, D52 times 855. And now we're also going to pay our livers, FL53 times 855. So D52 times 855 and L53 times 855. Our net, and you want to put on the exam that it should be 0. Mine will be 0 because I'm not rounding. Oops. So it's beginning minus claims minus claims. You got your dyers and livers. How far off could you be? Well, you look at that formula right there, it's 3.36289. It can be pretty far off. If I round this, just to let you know how far off it could be, the 2 decimal places, I'm off $800. So you can be off pretty far. Don't feel like you got to be within a few pennies. It can be pretty far off. The other issue you have is the portfolio. We round this to 2. We round that to do, whoops. Round that to 2. Round that to 2. We're off about 800. So you can be off quite a bit. Even with that small payout, $855, your rounding can still be off. But put on the exam, it should equal 0. Should be 0. And just realize with the rounding, you'll be off some. All right. So here, I'll notate that I'm rounding, so you'll know why it's not equaling exactly 0. Same thing here, same thing there, same, well, there's one other place somewhere. That might be it. No, right there. So there's 4 places you're gonna be off. When you multiply by 1.04, I'm only going out 2 decimal places, so. All right, so just realize it won't equal 0, but could be off by as much as $1,000 or so. I'll try my best to try to get the answer so there's not much rounding. I thought I'd try that here, which is the reason I had 855, but for some reason it wasn't as close as I thought. So, all right, any questions on that one? You probably have to rework this one at home to get some practice, but you can see if it's a 3-year policy, you have 3 Ds. You just have to know if it's endowment, add the L. The denominator looks exactly the same. It's 3 L's. You raise the D's to 1, the 2, the 3. You raise the L's 0, 1, and 2. You know, it's the same formula over and over again. You just have to decide how many L's and D's you have. All right. There's the second problem. All right, here, let's look at this next one. We're probably getting pretty good at this one because we've worked several examples that look very similar to this. Again, let's set up the formula. You do have to calculate it here, but let's getting the formula right. In fact, you can get a lot of partial credit if you just set up the formula correctly. Because I know math errors on exam anxiety, all that, that's pretty common. So get the formula down. So read through it, get comfortable with it, and then we'll try working it. We might have done this one in class too, so this might be a similar one. Critically on this one, remember, if you're paying an L, you just take the year minus the 25, and that tells you what you're raising to the power to. You're paying a D, you take the year that it's paid minus the 25, but you have to add 1 because L's happen at the beginning of the year, D's at the end of the year. So always remember that. If it's a D, difference plus 1. If it's an L, it's just the difference. It makes it a lot easier to get through these problems. All right, let's try it. I don't know how intimidating this problem is to you. Let me see if I can make it seem simple. So anything that's paid out goes into the numerator. So the first thing they say is they pay out people alive at age 95. So that's L95. They're getting $10 million. Sorry, the numbers are so big. And you're going to divide that by 1.04 raised to the what? It's age 95. They started this at 25. Any guesses here? It's just going to be 70, right? And then 95 minus 25. Don't add 1 because it's an L. If it's an L, you don't add 1. You just do the difference. The second one is age 96. So L96 times 15 million divided by 1.04 raised to here. You take 96 minus 25, you get 71 plus a death benefit, D99 times 20 million divided by 1.04. Well, here the key is it's age 99. So you take 99 minus 25, but you have to add 1. So it's going to be 75. So if it's a D, take the year it's paid out, the age is paid out, minus 25 plus 1. Now, I don't quite have it correct here, and I'll show you why in a second here. Some of y'all may have already figured that out. We're going to raise that to the 75th. But it's paying out to people alive at age 97, D98, and D99. So you have to add those 3 together. You don't subtract 97 minus 25, 98 minus 25, because you're paying them all at the end of 75 years. So those who die in age 97, their estate has to wait 2 years to get their payout. So it says at the end of year 99, it pays out those 3 groups the to $20 million, all right? Now, let's say you missed that one thing, that hurt you a few points, but it wouldn't destroy you. So get as much setup as you can. Get the obvious stuff set up. You get a lot of partial credit for the obvious stuff. If you have questions on that, let me know. And then the numerator is really simple. You just have the premium payers, L25 plus L26 divided by 1.04 plus L27 divided by 1.04 raised to the second. Now, these are all paying age 25, 26, 27. If I give you one where they pay at age 25, then age 30, then age 40, since they're L's, you just take the difference. So like the first L, it's L25. So 25 minus 25 is 0. So you're dividing by 1.04 to the 0, which is just 1. 26, you have 26 minus 25. So you divide it by 1.04 to the first. 27 minus 25 is 2. So it doesn't matter if the premiums are paid at age 25, 26, 27, 30, 40. You just can take that number, subtract it from the beginning year, and that's going to be what you raise it to the power of. So you do have to calculate it. We probably don't have time to calculate it here, but I'll set it up. We got L25, L26, L27, L95, L96, D97, D98, D99. Those are all the numbers you need. L25 should be 100,000. There's our L25, 26, 27. L95, L96, D97, D90, D98, D99. All right, so we have all of our numbers. So it's just a matter of setting up the formula. So D95, I'm sorry, L95 times 10 million divided by 1.04 to the 70th plus L96 times 15 million divided by 1.04 to the 71st plus D97 plus D98 plus D99 times 20 million divided by 1.04 to the 75th. All of that divided by L25 plus L26 divided by 1.04 plus L27 divided by 1.04 to the second. It's our premium. I don't know if that's the right premium, but I think we've worked this one before. It looks familiar. I don't know if I can check it real quick or not. Hopefully it's the right answer. I don't know which problems I gave y'all, so let me not going to test it. So we got age 25. It's pretty quick. You don't have to do this on the exam, although if we had it in Excel, I actually would have you do this on the exam. So you got a beginning value. You have added, deducted, beginning of the year, added, deducted. You have deducted at the end of the year, and you have the ending value. So our beginning value is 0. We're going to have the L25s pay that amount. Nothing deducted. The ending is going to be that amount we got at the beginning of the year times 1.04. Beginning value is going to be that amount. We then take the L26s. They're going to pay that amount. Nothing's deducted. So here we take the beginning value plus the premium. They're both at the beginning of the year. So we get 4% on both of those. We bring that down, give us some commas. Our last premium, L27 times 89.46. Nothing's paid out. We add those together, and then nothing happens until age 95. So we just keep bringing this forward until age 95. They do get to be pretty large numbers. And so at 85 and 95, this is going to be at the beginning of the year. So we're going to pay the L95s 10 million. So our ending value is going to be that. We're going to take those two. They're at the beginning of the year, so they're both can get the 4%. Bring that down. Then we're going to pay the L96s. We're going to pay them 15 million bucks. Hopefully this works. Bring that down. We don't pay anything to the L97s until later. So we'll just bring these down. And then hopefully this gives us a really round number. We'll see. Nope, it didn't for some reason. We'll see why here in a little bit. And we've got D97s plus our D98s plus our D99s times, I think the last one is 20 million. So that plus, well, it might work out. That times 1.04 plus that. Yeah, it looks like it works out down to 0. You don't do this on the exam, but I just want to double check it. So the death benefit happens at the end of the year, so you don't multiply the death benefit by 104 because it happens right at the end. So only the beginning value gets the 4%. Then we take out that death benefit, we end up with 0. So that is the right answer. No telling what I'll do in exam, but it's probably gonna be too radically different than this. The real key is understanding how time value money works. All right. Any questions on that one? This might be one we've already worked before, so not be too valuable, but you do have it. All right. Are any questions? So now let's do this one. This is the one we just learned this last. Well, no, this is a joint life. All right. So this one's one we probably do need to spend a little bit of time on. So look at number 4, a joint life. It is set up a little bit differently than the others. This is the one where you need to figure out the probability that they both live, because it's going to pay out only when one or both die. So the probability that one or both of them die is 1 minus the probability they both live. So you have to figure that out. One is age 90, one is age 92. So remember, when you figure out the probability of living, you take L91 over L90 times L93 over an L92. You just go out 1 year, you get that probability. 1 minus that is when they're going to pay out the $100,000. Once you do that, all you have to do is divide by 1.04 and you have your premium. So it's actually a much simpler formula. The reason we don't have to divide by the L's is you're doing that when you calculate in the probability that they both, or one or both dies. All right, so try setting up the formula first, and then we'll do the math. If we can get the formula set up, you can pull numbers from the table and do the calculations. So hopefully get the math right. Although you should test your ability to do the integer, the raised to the power of, and the parentheses. So let's figure it out. So the probability both live is going to equal L91 divided by L90 times L93 divided by L92. Probability one or both dies equals 1 minus the prob both live. So the premium is going to be probability one or both dies times 100,000 divided by 1.04. See how simple this formula is? It really is. We don't need the L in the denominator because we already did that when we calculated the probabilities. So let's bring in L90, L91, L92, L93. Wait, I just do L92, 3. So I'll go grab those from the table. So the probability one or both dies is going to equal L91. Make sure you're doing the right order. You want the higher year over the earlier year. 91 over 90 times 93 divided by 90 L92. So the probability they both live is 58%. You can go out just one decimal place. I mean, you can't just do it as like that. I'm going to not be rounding here. So 1 minus that. The advantage of going out a couple of decimal places, though, I will tell you, is when you're doing the reconciliation of the two policies, you can be better off with a couple of decimal places. I'm not going to round here, but I'll try rounding and see if it causes a problem. All right. So what is the premium? I got these on the wrong lines, but so the probability they both live is 58%. The probability that one or both die is 42 or 41.89%. So their premium is that probability times 100,000 divided by 1.04. It's going to be 42,275.69. Now, what if they bought 2 term policies? These are really, really easy. So set that up. How would you do a term policy for the 90-year-old? Remember, you have D90 times the face divided by 1.09 divided by L90. Remember that formula? You have D92 times the face divided by 1.04 divided by L92. It's the same formula you've been using, a really simple formula. You just add those two together. So write out those formulas real quick. All right, so the younger is going to be D90 times 100,000 divided by 1.04 divided by L90. Older would be D92 times 100 divided by 1.04 divided by L92. So we got I don't have my D's. Let me go get my D's. D90, D92. So D90 times 100,000 and 1.04 divided by L90. And then D92 100,000 at 1.4 divided by L92. You add those two together, gives you 45,676.24. That sounds too high to me, but hopefully we'll see. What is the difference? The difference is 45,000 minus 40,000. The difference is 5,400. What should that equal? That should equal the probability both die times 100,000 divided by 1.04. What's the probability they both die? That's going to equal D90 divided by L90 times D92 divided by L92. So that probability is D90, probably the first one dies, times probability that the second one dies. Now it does look correct, so 5.6%. So you take 5.6% times 100,000 out of 1.04, and there's your difference. All right. At a minimum, most students at least get this number here, the 40,275. That'll give you probably 50%, 40% value. Getting these two is just remembering the basic formula of life insurance. It's a 1-year term policy. So you got 1D times the face divided by the interest rate divided by the L. That's the formula. Remember, we did that with 3-year level term, but you have 3 Ds. Here you only have 1D because it's a 1-year policy. So you get that sum and you get the difference. So the difference should be the probability they both die times the face divided by 1.04. The probability they both die is the probability the first one dies, which is D over L, and the second one D over L. So there's all the pieces. The last part is the short essay. Go back to the class notes, but essentially older, younger, just by 2 term, because, and this is critical, probability both die is extremely low. So premium savings is negligible. I can't spell negligible, but whatever that is. For older, can make sense depending on purpose, policy. So the key here to talk about is why did you buy this policy? If the main reason you're buying a policy is that if one dies, the other gets some insurance, maybe offset a pension that's been lost, then that's fine. If there's something for your beneficiaries that if you both die, maybe because you have big estate costs or whatever, then maybe you need the 2 term policies. So you have to kind of think, if the first one dies, the second one needs it. The second one dies, the first one needs it. But if they both died together, you're just leaving money for the estate, then there's no reason to buy the 2 term policies. So if the main reason you're doing is each protect the other, then yeah, buy the joint, you save $5,000. And then if the first one dies, the second one has 100,000. So it depends on the purpose of the policy. Because here you are saving quite a bit of money. You're saving over 10% on this one. All right. So we have that in the notes. I won't redo all of that, but you have that in the notes. All right, we got one more. You have just enough time to finish this last one. This one's a pretty critical one. No one, I don't hear any questions coming. So this is what the ALM product column looks like. We might work another example of this on Tuesday just to make sure, because we've only seen it. All right, so the way you need to set this up first is get the capital charges first. Start with that. You got triple B and you have high yield. So get the capital charges set up first. Then you're going to do the income statement. Remember, the income statement is your income, which is your interest income, minus your haircut to get your net revenues, minus your crediting rate, minus your expenses. That gives you net income, and you get the ROE by dividing your net income by your capital charges. All right, so that's the format you've got to remember. I'll let you get started on that one. Boy, it's hard to get this to fit all on the screen. So hopefully you can all see that. I'll go back to the Word because it's a little easier to see. All right, so set that up. Start with the capital charges, and then set up the income statement. Now, if you're confused on this target RBC, remember when you set up the capital charges, you're going to take the capital charge 4% and increase it by 160%. So you're going to multiply 4.04 times 1.6. All right. So just remind you what that thing is telling you. You're going to take the 20 and multiply it by 1.6. So 100,000 times 0.04 times 1.6 is the triple B. 100,000 times 0.2 times 1.6 is going to be your high yield for the capital charges. Same thing on the C3 risk. It's going to be 100,000 times 1% times 1.6 for both high yield and triple B. This one's probably a little bit, we probably do need to work another one of these problems on Tuesday because you haven't seen it in this format before. All right, let me start with the capital charges. So for the triple B, you got C1, you got C3, and so you have your total. For C1, you're going to take the $100,000 times the 4% times 1.6. That's $6,400. So your 4% capital charge and your RBC ratio target 1.6, that gives you 6,400. And for high yield, same thing, 100,000. But here the charge is 20% times 0.2 times 1.6. The C3 risk is always going to be the same between them. So 100,000 times here, C3 risk 1%, 0.01 times 1.6. And then you add them across. There's your capital charge. So you start with that, pretty straightforward. Then for the income statement, you're going to take the $100,000 times your rates. Your rate for triple B is 5.5%. This is triple B, high yield. For high yield, it's going to be 100,000 times, and here we're making 9.8%. The haircut, notice the haircut is given right here, 0.1% for the triple B, 2% for the high yield. So you take 100,000 times, make sure you get the 1%, 0.1% typed correctly. It's 0.001. That's $100. And then for the high yield, it's 100,000. Here it's 2%. So use 2%. The crediting rate is given up here, 3.5%. So you just do 100,000 times 3.5%. That's going to be the same for both. Expenses are given up here. Expense load 1.2%. So 100,000 times 0.012. That's going to be the same for both. Your net income is going to be your income minus everything else. Your net income minus your haircut, minus your crediting rate, minus your expenses. There's your net income, $700 for triple B, $3,100 for high yield. Your ROE, you're going to take the $700 and divide it by the capital charge, $8,000. R for triple high yield, you take $3,100 divided 33,600. That gives you your ROEs. Your target is 9%. So the high yield gives you the 9%. The triple B does not, but it's close. All right. So there's the math. We'll probably work another one of these on Tuesday to get a little more practice. We're probably not going to work any of the others unless y'all give me questions that you're having trouble. But if you understood all the other problems, then just refresh yourself on this one. So what do you recommend? Only high yield achieves 9% ROE target, but we cannot realistically put more than 10% in high yield. So 10% high yield and 90% triple B and miss the ROE target. How much would you miss it by? Well, you can, do the math. Plus that times 0.9 plus that times 0.1 gives you 8.8%. Doesn't, you're going to miss it by a bit. All right. So look at the question here. We'll discuss the options to life insurance. So you have to tell me what you recommend. So my recommendation is not 100% high yield. My recommendation is essentially to miss the ROE target a little bit, by putting no more than 10% in high yield, because you just can't. Remember, insurance companies, they have $4 for every $1 net worth, $4 in assets. You can't put all that money. You can't put $4 into high yield if you only have $1 in net worth. I mean, you can't put 40. You can't put that much difference between the two. It's just too much. So so how can we get the 9%? And here you just go down the table. This is in the notes as well. So look at the notes. We did a really good one in one of our classes, but you just go across here. So number one, get better yields. Triple B, but you seek higher yield, usually means higher risk. So you can give the solution, but the caveat. Number two, reduce the haircut. Triple B, but it's already small and should use the correct number. So I mean, the key, I did it better in the notes, but 0.1% is the right answer. Use 0.1%. Don't artificially lower that number just because you can't meet your target. That's not something that you have any control over. Remember, we showed in the table that number can be 0 for several years and then suddenly jump up to 5% in 1 year. You need to set some of that across. The third thing is you can reduce your crediting rate, but that harms your competitive position. So that's not good. Or you can reduce expenses. See, I'm just going across the income statement. Reduce expenses, which is always good unless it harms service, customers, or something else. I forget how I put it in the notes, but so if you can cut expenses unless it harms your customers or the business itself. If you need those expenditures, yeah, but you don't say, hey, you know what, we're wasting a lot of money here and we're not making ROE, let's cut those expenses. No, you should cut the expenses even if you're making your ROE target. Anytime you be more efficient, you definitely want to do it. The next one is reduce your capital charges. So reduce the 160% target, but makes riskier and risk being downgraded. If you need 160% target and you shift to 150 or 140, you can be downgraded. And then the last thing you can do is reduce your ROE target. But if investors need 9%, you will pay for this or stock price. So go back to notes. I think I probably did it better the first time. I'll probably do it a little different each time. I think we even tried to come up with a mnemonic the last time. I can't remember, but essentially you just go right across income, higher interest rate, haircut, lower haircut, doesn't make sense. Crediting rate, less competitive. Expenses, always do it unless it harms the business. ROE has two pieces, your denominator, the E part of it, and then your target, the 9% target. You talk about each one of those. So those are the only two essays that you have. The one you have on the joint life, and then this one, they're not really full-fledged. You can be pretty short with your notes. Don't get overly short, but say enough so I can tell what you're saying. What I have written there is actually a pretty good answer. All right. Questions, comments? You've essentially seen almost the entire exam other than us working another problem here. Next week we'll do really important is go over some of the accounting, which is important for us to hit. But as far as the exam goes, we've got everything we need. One last thing I want to do, unless someone has questions. Any questions? Are y'all still there? Hopefully you don't have 16 people working on
I
paper
don't, I,
two.
I don't have any questions yet. Sorry.
Are y'all there? I heard somebody. All right, I'm gonna do one last thing related to paper two. I'm not gonna give you my paper two notes. However, I will one last time scroll down it very slowly, so it will be on the video. So if there's one part you're missing something, you can catch it. So I'm gonna go slow enough that you can catch it. Yeah, does that make sense to what I'm doing? See what I'm doing? All right. So you can. So you're welcome. Get off. You don't need this part. Um, it's a little tough when we have tables. Pause every once in a while. So feel free to get off. You don't need to see all of this, but you'll have to hit pause. I'm not gonna go slow enough. You can read every word. I'm going slow enough so you can hit the pause. I think on YouTube you can actually slow down the speed, can't you? So you might be able to. Problem is the page breaks, it just jumps. Got a lot in that section. Remember inconsistent cost and quality that you have an example of each. Inconsistent cost and inconsistent quality. A lot of students forget to do both. There's the chart I showed on that one, kind of an old chart. We talked a lot about inefficiency encouraged, although some of those fit under other places. Solutions, some abbreviations. Gave you some examples that you could do extra research on. Quite a bit under technology, including a lot of AI stuff and a lot of tech companies coming into this business. Yeah, process improvement Six Sigma, we essentially said you can combine that under lower cost models. And remember on end of life care, it did the rubric said cap end of life care, but I said don't say the word cap. That's just how you're going to deal with end of life care. Right now, the UK is debating an assisted suicide bill. It's pretty interesting. Economists actually had 2 or 3 articles on that. So that's something you could certainly address, either pro or con. Lower cost models, we did quite a bit there. Remember, when I give 5 or 6 examples, usually like medical tourism, you can usually use 1 or 2 and be good. I kind of went overkill every time I saw something. Yep. So that's the whole thing. All right. So that's it.